Good morning, everyone. I'd like to welcome you to our fourth day of the RIMS virtual conference for 2020. I'm absolutely thrilled to be sitting virtually alongside Dimitra Day, who is the head of the Major Accounts Division for Australia, New Zealand for Chubb, and just absolutely blown away by the fact that Juan Luis Ortega, the Executive Vice President of Chubb Group and President of the Overseas General Insurance business, has agreed to share an hour with us this morning, talking us through his views. It's actually been something of a RIMS tradition that one of the magical two or three, whether it be Juan or whether it be Mr. Key or Mr. Greenberg, they share time with us, and we're deeply honored that Juan, you've chosen to share your evening from Miami with us today, so thank you. Obviously incredibly grateful to Chubb for making this possible, and Dimitra, thank you for lining this up for us. I, of course, start the day with our acknowledgement of country, and I acknowledge the traditional custodians of the various lands on which we work today, and the Aboriginal and Torres Strait Islander people participating in these sessions. For me, that's the Daru people, and I pay my respects to their elders, past, present, and emerging. In terms of the Zoom features, you'll all be old hat at this now, but just a reminder, cameras are to be turned off and you're on mute. There is a Q&A function. I urge you to upvote your chosen questions. I'm sure there'll be quite a few coming through. Obviously, ANZIF and NEBA points are awarded at the end of this, and you'll get your certification at the back end of the session. In terms of Juan Luis Ortega, I've obviously introduced him by title, but in terms of the pedigree we're talking about here, Juan is responsible for Chubb's general insurance business in 51 countries outside of North America. And that includes the P&C division, traditional specialty, personal lines, A&H business. It's obviously an enormous footprint that Juan is responsible for. He has more than 20 years of industry experience, as you'd expect, and prior to his current role, he served as the regional president of Latin America from 2016 to 19, the regional president of Chubb's Asia Pacific operations from 13 to 16. And that was a period in which, of course, included ACE's acquisition of Chubb. I could go through a laundry list of Juan's credentials, but they speak for themselves, and I think I'd be wasting your time if I spoke for more time, and I'd rather hand it over to him. So I'll hand over to Juan, and then Dimitra will pop in and facilitate some Q&A for you. Again, Juan, thank you very much indeed on behalf of RIMS and for sharing your time with us today.
Thank you very much, Kevin, for the introduction. Dimitra, good to see you. I also want to thank RIMS for inviting me and you, of course, for the invitation. It's really an honor to be talking to this audience. I am actually not coming to you from Miami. I'm actually coming from New York, which fills me with energy to be back in our home office, which just opened after our Labor Day here in the U.S. So thrilled to be back and thrilled to be having the opportunity to talk to all of you out there. As you know, at Chubb, we're deeply committed to the region. And I think we have a fantastic franchise with fantastic leaders that play a very important role and have played a very important role throughout the history of ACE and Chubb. Not only in Australia and the Asia Pacific region, but more broadly around the world. As you said, I had the luxury and the honor to live in the region for 6 years. I was based in Singapore. I had 3 kids that went for 6 years to the Aussie school in Singapore. When guests would come to my apartment building, they would ring up the phone and my at that time 6-year-old daughter Emma would answer, and my guests would say, no, it's some bunch of Aussies live there. She had such a heavy Aussie accent she had built up by being at the Aussie school. So I feel like through my time in Singapore and my frequent visits to Australia, I have no doubt developed a special relationship that I carry everywhere I go. I have built lifelong friends from Australia. I have admired colleagues from Australia, and many of them have become both friends and colleagues throughout the years. So again, just a pleasure to connect with this audience. So today, as the title suggests of this presentation, you've probably throughout these days heard quite a bit about COVID and rates and the market and what's it doing. And I wish I could bring something new as a title and of themes to talk about, but the reality is no, I will speak to all of these things that you've probably heard a lot about. But I hope that the Chubb perspective brings something different. We do have a global footprint. We have a hard-won leadership position, I believe, around the world. And that spans across commercial P&C business and consumer lines, retail and wholesale. So I do think we have our finger on the pulse and something to say about the current conditions. I do have lots of slides to go through. I think the count is about 24 and 25. But I will try not to make this just a page turner and have enough time for Q&A, which is the fun part, I guess. So again, I will speak, and this is about COVID, about the impact to the market, about pricing changes, trends, and I'll sneak in a little bit of Chubb at the end, trying to tastefully address who we are and what we're doing without making this just a full-blown commercial about who we are. So as I start, I guess I call this slide the dark cloud. And the reason I say that is when we see just a few things on the macroeconomic picture, you have the highest debt government held, publicly held, but government issued since the end of World War II, when the whole world nearly collapsed. And on the other side, the US, just as an example, has built already up a $4.2 trillion deficit, which is 3 times higher than what it was built up right after the financial crisis. And we all know how long it took for that to unwind and for the country to recover, and really for the whole world to come back from something like that. So we are really deep into this. And the hangover that we will have from all of this unprecedented times will no doubt be with us for quite some time. It's difficult to predict exactly the consequences that we'll have. But, you know, a few things we can tell will be part of the spillover we will have. GDP growth will slow as an underlying feature. We may see an uptick just as we recover, but the damage done to the economic pillars of the world will be with us for some time. There'll be trade disruption. There already is trade disruption that will come with geopolitical tensions. We're already seeing that, how deep and how aggressive those tensions become. Only time will tell. And for the audience, in the midst of you're as close as it gets to the broader Asia, so that no doubt you're feeling that. And on top of this whole environment caused by COVID, but with other underlying issues underneath it, we have a U.S. election, and I try not to be too U.S. centric, but it is an important country, no doubt, and it's going through a consequential election, which I will try not to comment because I am an immigrant waiting for my citizenship, so I don't want to get on the wrong side of either one who might win. I have it bad enough to be a Latino in this country right now, so I'm not going to overplay my cards. But that'll be consequential, no doubt. So enough for the dark cloud hanging over us, and I think let's just go into our subject matter, the P&C industry and the insurance market. I think it's just easier to grasp. And basically, what I lay out here, I hope you can see that, although it's small print, it's just the several vectors that are coming together into our industry. You have the COVID impact, we'll talk more about that. You have a loss and pricing environment that was already moving even before COVID hit. It's broad-based, as we know, and it's gaining momentum as we speak. We also have declining investment yields, and that, as we will see, is a very big factor affecting our industry. You also have, that brings about, I guess, conservative behaviors from carriers, from insurers, and the way they manage capital, deploy capital, and safeguard capital. You have depressed insurer valuations. The market has hit the valuations, the market valuations of insurers in a significant way. So that will no doubt spark some interesting ideas around mergers and acquisitions in the industry. So that's another vector that's playing here. And what all this brings is a little bit of uncertainty. And with uncertainty, many times, and this is the same, or this is no different, you have a flight to quality, and flight to quality, we believe, is a feature of these trying times. No matter where or what industry you're talking about, there will be a flight to quality to look for certainty in uncertain times. So with that, let's move to COVID impact, which is, again, the first vector I mentioned on the previous slide. So as we look at the what we believe and Lloyd's believes is the biggest loss event in history, or the history of our industry, we believe, and Lloyd's believe, it's around $100 billion for the industry, COVID alone. You will see others that through different sources put it in the range of $30 to $80 billion. What we know is that 20 to 25 billion have been announced in companies, insurers, companies' reserves. And in this next slide, you'll see what I can tell you that we are that Swiss company that has posted a $1.3 billion reserve. We gave you flags here, just not to name every carrier. Out of respect, we can name that carrier afterwards if you want to guess which one it is. But I think you'll be able to spot the usual names behind the country of origin of the carriers. But I think what this slide tells us more than anything is that there are two different approaches to insurance companies reserving in the middle of the pandemic, or reflecting the losses from the pandemic. There's one extreme which says we'll reserve to ultimate to the extent that we can know what this loss will bring. We'll cut across all our product lines and determine what do we really think the loss will be. And I would put Chubb in that camp. There's also a different approach which takes the expected COVID impact on losses and nets out the expected benefit: lower activity, less people driving on the streets, less activity in the economy, less trade. That all brings a lower loss ratios to insurance companies. So they take the point of view of netting one with the other probably, and they come out with lower reserves, or a pay-as-you-go type approach, right? Rightly or wrongly, it's just two different approaches. The other source of discrepancies tends to be beyond physical loss, beyond business interruption. What is on the liability or long tail side of the equation, and that's always harder to predict. But no doubt there will be an affectation across financial lines and general liability as to COVID generating losses. So if we look at beyond COVID, I'll skip this slide for now, but it gives you another sense of just the reinsurers. These are not insurance carriers, these are reinsurers, and the loss reported as a percentage of equity and as a percentage of premium, just so you get a sense. But if we go beyond that and we take a look at the 2020 outlook, again, the first vector being COVID, there are other things happening in our industry. If you look at the slide, our industry tends to run at over 100% combined ratio. So I think this is a pretty informed crowd, but the aggregate of losses and expenses against premium it usually runs over 100%. In every year for the past 30 or 40 years, except for 3 consecutive years between 13 and 15, the industry ran at 100, over 100, or very close to 100. Now, that is really a sad statement, I should say. I'm part of the industry, but it is a sad statement to say we're in the business of underwriting, and I'm talking about the community of insurers, yet we failed to make a profit more than 3 years in a row in the last 40 years. You know, for those of us who know Chubb, that's not who we are. Our results look significantly different than this. And it speaks to our consistency and stability and underwriting discipline, which makes us more predictable and more consistent throughout the years. So that's the underwriting side. That's just one component of an insurance company's P&L. Probably the most important for us, certainly the most important. And then you have net investment gains. If you could, as you see this slide, you'll see that for the most part in blue, the investment gains is what ultimately generates end of year, fiscal year profits, right? And this is what's happening to the 10-year treasury rates. We're at a stage in 2020 where treasury rates are just over 0.5%, dropping significantly since 2018. So the source of investment gains is pretty much gone, right? So if you don't make money on underwriting and you have very little to go by way of investment gains, then the equation gets pretty tight. So as a result of all of that, you need to get a combined ratio improvement. And I won't spend too much time. I realize this slide can get a little bit complicated and too many boxes. But the bottom line is commercial rates and the rates on the risk we take have begun to move since 2018, as you can see on that slide. And this is the way to cover the fact that there's been underwriting losses several years and investment gains are hard to get. So if we just look at this slide, there is a loss cost trend, which is 4.5%. So without doing anything, losses tend to grow at a 4.5% annual rate. So that would say that for the insurance industry to be level and on par on the aggregate, right? There are different sectors on that aggregate, but on the aggregate, we should be pricing at a plus 4.5% rate on the total aggregate of global premiums, just to keep track with loss cost trends. So what you're seeing is a reflection again of multi-years of losses and trying to keep up with loss cost trends, and without or very reduced benefit of investment income. So as that turns into reality, this is a slide on general liability for the U.S. Casualty rates on the right and combined ratio on the left. So as rates start to move upwards, combined ratios start to drop. As you can see, we're still over 100, even as we go into 2022. So expect more rate to come through in the next few years. You may be tired of hearing that story, but it is here, and it's here to stay, probably. Commercial property, again, rising rates as of first quarter or since first quarter of 2018, and combined ratios that start to drop but the issue with property is the volatility. And that volatility, you need rate to cope with the years of high volatility, no doubt. Then we go into securities class action, or D&O, and here's what's happening in the U.S. with securities class action. Interesting to see the dramatic increase in class action filings starting to grow since 2016. And as we look at the number of companies that are publicly traded in the U.S., and this is just a proxy for other environments, but we went from 5,600 publicly traded companies in 2014 2004 to 4,400 today. So we have about 1,200 less companies being publicly traded, but you see the dramatic rise in securities class actions. So that's what's driving increase in rates or pricing for directors and officers coverage for U.S. public companies. So it's very dramatic. And I guess for those of you who are buyers of this coverage, which no doubt everyone is in the audience, this just shows you that what you're going through in Australia, you're not alone in the world. It's painful in the U.S., in the U.K., in the continent of Europe, and in really in every part of the world. So what's happening in that was the U.S. That was a U.S.-centric view, and we'll move into the European market. UK property rates or property pricing up 16%, liability up 5%, commercial D&O up 64%. On the continent of Europe, property up 10%, Finline's up 22%, and the London wholesale market, perhaps the most dramatic increases that we can see around the world, are there, and they began probably earlier than everywhere else, and they continue to have momentum we see into 21 and 22. So what about the insurance change? Because that's for the most part a retailer or an insurance company point of view. Here we see since 2018 which sectors, whether it's commercial property retail or global reinsurance or US CAT excess of loss or the retro markets, how have they moved in terms of rate change since 2018? And as you can see, that curve is pretty much driven by commercial property on the retail side and the retro markets with a little bit of the US CAT excess of loss market. The global reinsurance is starting to move. So I believe we will see that rate flattening a little bit, not downwards, but just flattening to a higher level across all actors in the insurance chain. So that is kind of a quick view of the market. I think I'm getting to the halfway point of where I should be, and I'll move a little bit quicker. Chubb's results, and I said I'll speak little about Chubb, but here it is. Second quarter, which is our latest publicly available quarter, net written premiums flat year over year. We do have a significant consumer business around the world that weighs down our growth as the economies were shut down. But we take actions on expense ratios to keep ourselves efficient and be able to cope with market conditions. Balance sheet remains exceptionally strong, $70 billion of capital, $66 billion of loss reserves. So the COVID for us has been a P&L event, not a balance sheet event. And moving forward, what are our key initiatives and key priorities? So far, we've been very focused on operating seamlessly from home and making the transition to home and then from the home back to the office. We have a lot of heroes in our company and the IT and operational staff that put it all together for us to be close to our clients and our trading partners. Just did a phenomenal job. We were never shut down. We were always available. We also posted a $10 million relief fund through our Chubb charitable foundations. We've supported clients, whether it's through engineering and pandemic responses, or exposure adjustments. We have stayed true to a no layoff pledge during the health crisis. We've worked hard on diversity and inclusion, or accelerating our initiative on diversity and inclusion, because as you know, we went through some difficult times in the US, and we're still going through that, and we take that very seriously. And we've also offered, I think, thought leadership on private and public partnerships to cope with business interruption for the next pandemic. We've learned quite a bit, and we've put that knowledge to the test and offered governments a solution that we can, again, collaborate privately and publicly. Second half priorities, we're getting back. We're back to meetings, back to office, all around the world. Our teams are back. We're making significant digital investments, whether it's on the glass products for our agents and brokers, or on the consumer side, the ability to have in a single software, a whole distribution engine to promote and distribute consumer insurance products, keep adding resource and capabilities to our Worldview capability, which is our major account technology platform, maintaining our culture, which gets very difficult when you're locked down and away from each other, to keep that bond and that strong culture that distinguishes us. And restart our Chubb Associates program. We have young people from around the world joining our company every year, and we literally send them from country to country, region to region, and we're restarting that as things normalize on the travel environment. I won't go through this. This is just a sense of what the public-private partnership initiative from Chubb is. There are others out there from other players, and we welcome the dialogue. But in essence, it's a deductible of $15 billion that would be covered by the insurance industry, and excess of that, up to $735 billion or $400 billion would be covered by governments. This is the proposal in front of the U.S. government, and again, it just shows thought leadership to move ahead and be ready for the next pandemic. So really, that's all I had as far as the presentation goes. I did want to say a few things just to close and before we go into Q&A. First, again, thank you for taking the time to listen. I wish the format would have been different. I wish, those of you who know me or know Chubb know that our way is to be there with you, get on a plane and meet direct and engage, have a live conversation. We are very much a work from office company, and we're excited to be back. I think also at Chubb, again, we're deeply committed to the international space and to the region. We see the highest growth prospects of anywhere in the world out in the Asia Pacific broader region. And we in all of that, we understand that we need to earn your trust. And with your trust, we will ultimately earn your business. And we need to keep earning that business every single day with everything we do. And in this changing market, which is no doubt challenging, we're committed to an honest dialogue. We remain consistent in our approach. You may not like it sometimes when we talk about price increase, but our view is that we need to stay consistent to what we do, to an underwriting discipline. And we just strive to anticipate the news, work with you, work on different structures to cope with that. For those of you who currently work with us, I am very thankful, and we are all very thankful for your business. And for those who don't work with us yet, I hope you took the flight to quality as a direct invitation to work with us, because that's how I meant it. So again, thank you very much for the time, and let's move to Q&A.
Thanks, Juan. Always informative. Good morning, everyone. This is Dimitra Day. I'm going to ask Juan a couple of questions before we get into the Q&A coming from the audience, which is starting to roll through. The first really important question, Juan, is obviously with having your kids go to Aussie school for such a period of time, important question is, how is their Aussie accent now?
It's interesting. They can turn it on and off at will. If they're now in the U.S. and they've been here for 4 years, but they regularly speak with an American accent. But I can get them to turn it on, and they put on the show. It's great. Yeah.
Truly international. Well done.
Yeah.
Okay, so Juan, in your discussions globally with insureds and brokers, what would you say are the top 3 issues on their mind that we, as an industry, can respond to?
Yeah, I think, and this moment is very, very particular. It brings up subjects, but I think it's probably 3 or 4. But I'd say Nat Cat, just exposure to natural catastrophe, global warming, more frequency of large events, et cetera, et cetera. You know, you see the bushfires everywhere in the world. Australia's no stranger to that. You see the hurricane season and what it's doing, and now you seem to be adding a pandemic to the way we think about things. The other thing I would say is cyber risks are very much top of mind. It's an evolving one. But you know, just in the 6 months since we've been on with the pandemic and through lockdowns, there's been a 450% rise in ransomware attacks, right? So I think that's coming to the fold very clearly. You know, and I think, you know, I think the other one would be even the work from home scenarios, and as they project themselves into the future and the new working environment, those who have taken a view that they will go more for work from home, what risk does that bring, and how is that play on the liability space, for example? So those are just to name a few.
Okay, thank you. So following on from that, I mean, I think everyone would agree relationships are one of the key drivers in the insurance industry, and they've certainly been challenged of recent times with portfolio remediations across various parts of the industry and portfolios. So from Chubb's perspective, what are we doing or what are you seeing that we're doing to manage and alleviate these issues?
Yeah, so I think if and when we do need to take action, we first of all try to be very clear and anticipate our actions, so that our clients can react to them with enough time, and that's first and foremost in our minds. Now, I would say that for the most part, our consistency allows us to not have to take action or broad-based action on entire portfolios, entire regions of the world. In many ways, throughout the soft cycle of pricing, the market moves away from us. We don't move away from the market. Then when pricing is adequate and we are getting paid for the volatility that we need to take, we find that the market comes back to where we have always been. And we benefit from that, having stayed consistent. So we grow in our exposure base. But fundamentally, and there are those times when we do have to take some actions, we anticipate, we provide enough time, we're very clear, and we're always, I hope, we're operating locally in a way that we're offering different structure solutions to keep the budgets in some sort of normality for our clients.
Yeah, absolutely. It's about transparency, early messaging, and making sure that we're working as a partnership, both with our brokers and our insureds. I'm going to turn to some questions that are starting to come up on the Q&A panel. The first one is from Trevor Cuthbert, and he says as follows: fascinating presentation, thank you. What do you see as being the biggest challenge for Chubb? Competitive pricing or allocating capacity for the exposure?
They go hand in hand, right? I don't think there's an easy way to separate those two or pick from those two. So in that sense, I would say that our biggest challenge is a mix of both of the two, and it's in certain areas where our clients, it's not our clients, it's not the industries our clients are in, it's the legal environment surrounding our clients and their industries that's ultimately affecting them and the risk transfer process, right? That's the most challenging, because there's no way to risk engineer, there's no way to structure your way out of that situation when the entire legal system in a certain place is bringing out the worst of exposures, right? And it's something you can't really control, our clients can't control, and that's probably the biggest challenge, I would say.
Okay. Probably leads into the next question. So we've had actually our first bad quarter for quite some time from a Chubb perspective in the context of our financials of one. Do you see this as being purely a catastrophe and pandemic driven, or are there other drivers which concern you as being potential indicators of arguably a bleak next few years?
Yeah, that's I appreciate that question. Inside of our company, we say there are no but-fors. But in this case, I think you can put a but-for COVID in one single quarter, having to cope with a big increase in reserves as we posted for what we consider the biggest event in history. But let me just put it into numbers, right? Q1 of this year, we grew 9.3%. Across the entire corporation, and this is the biggest P&C insurance company in the world, growing at 9.3% in the first quarter. Our combined ratio, all in, was 89.1%, and our combined ratio excluding CAT events, which in the first quarter just were natural, traditional CAT events, was 87.5%. So that speaks to the resilience of our business, and that's really the underlying you're dealing with, right? Q2 had COVID, but again, but for COVID, that's how we were looking right before it. And I can't make predictions, but I think the underlying will continue to shine through as we move forward.
Yeah, thanks, Juan. Leads me on to the next question, which is related. Chubb have always said that they would stand by our clients. Do you feel that Chubb will completely withdraw from any lines of business as they are simply unprofitable, and the underlying market metrics don't show signs of improvement? Do you see Chubb exiting any lines of business on that basis?
Nothing in my map that I can see from around the world would suggest that. We may dampen our appetite for certain sectors and certain products, but withdrawing, that's not in the cards for now. We have already signaled, and it's probably the first time in many years where we've actually withdrawn completely from a product line, which is transactional risk, or M&A insurance. And we did that after many years of observing that we weren't able to get the right price for the volatility that was coming our way. So we did that, plenty of anticipation, and handled that. But as I look into the future, again, other than appetite modification to certain specific spots in the marketplace in certain countries, but stopping short of withdrawing completely, right?
Yeah. Okay. One more, another question coming from the audience here. One, this is from Lokesh Thondavada. I hope I pronounced that properly. Thanks for the world overview insights. and appreciate your thoughts, Juan, in relation to COVID BI claims, business interruption claims, and where policyholders are challenged and taking insurers to court, especially in the US, UK, and Australia. And obviously that comes from the news yesterday of the federal court decision in the UK. So would you like to provide some insight, please, Juan?
Sure. So I'll start with the US, even though it's not my territory to do business with. I live here and I'm aware, of course. In the US, the fundamental question being debated is whether COVID represented physical loss, right? And we know where we stand on that. We are very clear that it does not represent physical loss, and for the most part, BI coverage in the US is granted on the basis of physical loss. On that question, the scorecard is, and I'm please don't quote me on these numbers, but I'll give you the latest I remember hearing, is around 10 out of 12 court proceedings, 10 have gone in favor of COVID not being physical loss, and 2 in favor of it being physical loss. Now, these are lower district courts or circuit courts, and there's a long way to go on that battle. But that's the score at whatever this is, 5 minutes into the game or whatever, right? 10-2. On the other hand, you have the UK, big news everywhere right now. There was a test case, which I won't go into the detail because it was a test case different from Australia. It was a test case on many different aspects and wordings and sections of wordings. We were not a party to that test case, but we have seen how it's shaping up, and what the judgment was. It's kind of a mixed bag. There's something in it for everyone, depending on what form and wording you're looking at. We do have some exposure to some of those wordings, even though we were not a named defendant on the test case. And we will see how, now all of that needs to go through either appeal or through the specific nature of each and every claim. But it's so complex that I'd rather not go into much more detail. And as far as Australia, the test case is as at this stage is in many ways, compared to the UK one, a much simpler binary choice on the Biosecurity Act, right? And that's all playing out right now. I think when you step away from it all, whether it's the US system, the UK test case, or the Australia proceedings, I think everyone in the industry has learned a lot about drafting forms and staying true to clauses, and any deviation in a word, or a mile versus 5 miles, or a kilometer versus 5 kilometers, a security act versus. There's a lot of lessons to be learned on this whole thing, and I think that the industry has paid attention to it, no doubt.
Yeah, very complex topic. Okay, I've got questions coming in thick and fast now. This is from Katie Sexton. Thank you, Katie. Very insightful presentation. You talked about the technology advances Chubb has progressed during COVID. How would you like to see insureds grasp technology to improve their risk management?
I think data provides the answer. There's so much advancement on data, on artificial intelligence to crunch data, on even the access to data that was previously difficult to access, and now it's available, and you can scrape the web for a bunch of things without even asking your insureds to provide you with their own data or their own features of risk. So I think the key is on data. That's where things can really, really change, both in the nature of the relationship and how much how many questions you need to ask to underwrite something, to the insights you get about risk, about volatility, about pricing for that risk. Again, the key is in the data. And if anything, what insurance companies have is a ton of data, and now that can be enriched with data that's out there and available. And if you can have the capacity to, in a very fast way, and I'm talking milliseconds, crunch it all and learn from it all, and have these machines that really are learning from it, then it gets really interesting, really interesting.
Yeah. Thanks, Juan. This is a question from one of our Chubb staff, Ryan Spedigue. And here it goes. Hi, Juan. With COVID-19 being the single largest loss ever, combined ratios above 100%, and investment gains are difficult to come by, where do you see the opportunities for Chubb? Good question, Ryan.
Ryan, first of all, say hello to your dad, Neil, my big friend, my good friend, I should say. So, I think, take decreasing investment yields, take COVID losses. We continue to see opportunity in exactly the same way across all the sectors where we would have seen it in March 1st of 2020, right? Nothing has changed our view of opportunity, and it is an optimistic view of opportunity, right? We are committed, and we love our major account space, global accounts. We think there's a ton of growth for us in that space. We've made investments in small commercial and how to access those customers. We've refined our middle market space, distinguishing it from major account, which has its own characteristics, and we're committed to growing that business internationally and in the U.S. We're also committed as ever with our consumer space, and we're investing in technology to make our offers more digital in the consumer space. There are still, we like planting flags in many countries, and there are still countries where we don't have a presence. There are a few, but we still have an appetite for geographical expansion. We have an appetite for geographical expansion even in the countries where we are currently at, and getting more granular relationships across those countries and expanding branch footprints. So I could go on and on, but the opportunities that we saw before remain intact. Sure, you adapt to geopolitical events, you adapt to market trends, but we're excited about growth, and we see it again in exactly the same light, roughly speaking, in exactly the same areas and segments as we did, January 1 this year.
Yeah. Thanks, Juan. Another question from Kelly Murray. Thank you for the presentation. How do you see the broader client insurer broker engagement and relationship evolving as we continue to work in an environment with restricted travel, site visits, and face-to-face meetings? Good question.
That's a great question. I think, I guess, first of all, you will see us push the boundaries and being in a leadership position in terms of getting back out there, whether that's people going to office and trying to meet, or whether it's international executives flying around the world and meeting you. We will stop at anything that puts our employees' health at risk or at increased risk. So we're very cognizant of that. But you will see us try to push the boundaries, knowing that there's a very fine line, and we don't want to cross it in terms of health. But put that to the side. We want to break every record in terms of Zoom meetings or WebEx meetings that we can set for ourselves. We want to be out there. We want to be having meetings, having conferences. I keep hearing from markets that we are doing a good job at that. That we are sometimes they're getting tired of us in terms of we want to be on WebEx and Zoom all the time. And I hope that continues to be the case. So as as long as the world prevents us from personal face-to-face interaction, we will exploit the hell out of this environment.
Absolutely. I think we're all a little bit Zoom and WebEx fatigued, but it's the nature of the current environment. So we're getting into a couple of technical questions here, Juan. One that you touched on your concerns in regards to cyber. Does the contagion nature of cyber insurance concern you? And that's probably a leading question, but leave that with you.
Yeah. Well, I think cyber is the next pandemic, full stop, right? Yeah. It's the biggest thing. Right. It's the biggest worldwide risk we have. It's infinite in nature at the end of the day, just like a pandemic. There's no time limit. There's no geographical limit. It's not a hurricane that you know where it's going to go through and it's 3 days of pain and that's it. It's not an earthquake. It's not, hail. It's totally different in profile than a NatCat event. So from that perspective, it is of concern. It should keep us all up at night. It's something that can bring down industries, companies, countries, and continents. So risk management around that is critical. And learning more each day and how to understand that and how to dimension the exposure is critical. And we take it very, very seriously.
Thanks, Juan. I did promise you another technical question. This is from Che Wilkinson. To what extent are insurance-linked securities a solution or not for a reinsurance market under pressure? And second question, are there better or other solutions given the globalisation of underwriting is levelling risk opportunities in specific classes or locations?
Dimitra, can you give me part 2 of that question again? I was writing part 1.
Yeah. So part 1 you have. Second part is, are there better or other solutions as compared to insurance-linked securities, given the globalisation of underwriting is levelling risk opportunities in specific classes or locations?
Yeah, I think on the first one, ILS, yes, it is a valid solution. We coexisted with it. We sometimes use it, and I think even though it's in a relative decline to its height some years ago, I do think it's a part of it's part of the risk transfer process, and it's probably here to stay. On the other question, whether are there better ones than ILS, are there new ones out there different than ILS? I think as if I think more of a grounds up cover rather than on the excess space. I think and given the pricing environment again, I think what should become a little bit more in use is self-insurance schemes, right? And insurance coexisting with captives, insurance coexisting with self-insurance. I think that's at the bottom of the pyramid if you want, but it's an important factor in the entire pyramid. Even before we go into the excess layers and ILS as a solution. So there's just got to be more. But giving you an answer on is there this specific product that's better than ILS? I don't have that answer.
Yeah. Okay. A couple more questions. We've got 5 minutes to go. So the next one is tricky. From Kerry Kohler Saunders. When do you think the market might begin to transition into a soft market?
Well, here's what I'll say, right? We see it clearly into 21 and 22, the hard market. But it's interesting because when we speak of our view, right, it's primarily informed by how we view adequacy, rate adequacy, given risk. Now, when we talk, we're coming from a point of view of a disciplined underwriter that has managed the cycle, did not chase market share when things were cheap and soft. So our view of when we reach adequacy is one. Others' view of adequacy, if they've gone through more significant pain in the soft cycle, it'll take them longer to come back. So from their perspective, they may have a different answer. That may go beyond 2022, right? So it's just the perspective of one player in the market. It is a big marketplace. So if you have gone through more pain, you need to take more drastic action. You need to take more drastic action, one cycle after the other to perhaps get to adequacy or equilibrium, however you want to call it, right? So I'd be interested in you telling me what other carriers say about that question.
Fair response. Okay, a couple more questions. This is from Lukash Thandavada. Chubb's CEO, Evan Greenberg, is the only insurance industry executive named in the US President's Economic Revival Industry Groups back in April 2020. Is there anything you can share out of this group, especially in the context of economic recovery for the insurance industry?
Well, no, because that's something that he does not share with his executives. That is very much something that he does as part of his very public profile and leadership beyond insurance. So if you're asking me what anything that came out of that group that I can share here, I got nothing for you. Sorry, that's on the privilege of that group. But I will say this, those of you who have heard my boss before know that he's a very, very informed, rational thinker about world issues, industry issues, way beyond insurance. So I'm happy for the world that he's sitting on all these groups because I can imagine his advice would be very sound and pro-business in a very rational, sensitive way. So, sorry for the non-answer, but that's it.
That's all right. No, it leads actually into the next question and the last one that I'll pose to the group from Alejandro Martinez. Thank you for the insightful presentation. In this Nike-shaped market trend, I like that we expect for the following years, what do you consider the main points to focus within the insurance industry in order to achieve an efficient recovery?
Could that first word you used, what was that? In this what market?
Nike, as in the tick.
Okay, got it. Yeah.
As in positive rate trends, yes. In this Nike-shaped market trend that we expect for the following years, what do you consider the main points to focus on in the industry in order to achieve an efficient recovery?
Well, I think it's Nike profile. I guess it's again, that first of all, that Nike profile that we saw, I think should flatten, right? It should be the first thing I think one of the things you're going to have that changes that graph is again the global reinsurance space upping up their game in terms of pricing, and that will flatten that curve. And I think as we recover from, or as the industry recovers from many years of misbehavior on the underwriting side, I think it's in order not to lose the trust of your client base. Ultimately, you need to be sensible. You need to be anticipating the news. You need to be honest and transparent. We cannot hurt the credibility of the industry, even though the industry goes through these cycles every 20 or so years. We got to treat it with respect. We gotta be again, sensitive, transparent, honest, and above all things, anticipate the decisions we intend to make, so that the industry doesn't lose credibility. But it is challenging times. It is very dynamic, and we should all do our best not to harm the name of our industry in the process. Absolutely
agree, Juan. I think we'll wrap it up at this stage. We really appreciate your time, Juan. Appreciate that it's the end of the day for you. Thank you for all the questions from the audience, and thank you also to RIMS Australasia for allowing Juan to present. Appreciate everyone's time. I think at this point we'll sign off, and everyone have a great day.
Yeah, Juan, personally, thank you very much indeed for your usual candor, your transparency, your authenticity. It's been an absolute privilege to share the last hour with you.